So I just want to jump straight to the point. Overpaying in taxes just really sucks. What if there was a way to actually reduce your taxable income, save more of your hard-earned money, and also use that money towards your retirement? If you didn't know what I'm talking about, the plan I'm referring to is called the 401k, and in today's video I want to go over all those details with you right now. Welcome. If you're new to the channel, my name is Oliver Jan. I love to talk about personal finance, entrepreneurship, and financial independence. In today's video, I just want to share why the 401k is such an important vehicle for financial independence and some of the benefits that you can actually take by contributing today. So just to start off, I want to go over a little bit about the history, some of the mechanics, as well as a lot of the benefits of having a 401k and how to actually take advantage of some of the incentives that come with having a 401k. So the 401k was started in 1978, and it was a way for employees to contribute to retirement. The way that this worked was that employees could contribute a certain percentage of their income to an employer-sponsored retirement plan, otherwise known as the 401k. The 401k allowed money to go in pre-tax, which means you can bypass any taxation, and all that money can sit there in that account up until the age of 59 and a half, and therefore at that point, when you turn 59 and a half, you can start to make withdrawals from that account, and then that money that is withdrawn will be taxed at your tax rate at that age. So those are just some of the basic mechanics of the account. Now I want to talk about some of the tax benefits that go into this as well. So some of the tax benefits of the account are that yes, the money that goes in is indeed pre-tax, and the money that comes out after the age of 59 and a half is then taxed later on. This is something known as being tax deferred. So therefore, you're actually withholding taxes until much later on in your life, which allows this type of money to grow in this type of account without being taxed, and it can sit there for all these years. The 401k is really special in that the money that you contribute to this account will actually go against your taxable income. So in layman's terms, if you make $100,000 and you contribute $10,000 into your 401k, instead of being taxed on your $100,000 income, you're going to be taxed on $90,000, which is $100,000 minus $10,000. So this is really great because now that your taxable income is lower, you're effectively going to be paying less in taxes. So the other thing to note with this is that once you make these types of contributions, your paycheck on a bi-weekly schedule or monthly schedule or however your pay frequency is will be effectively lower. So you might want to think about those repercussions onto your personal finances. So the other aspect here is that you're actually deferring your taxes until much later on. So by putting your money into a 401k, if your tax rate currently is quite high, you can actually avoid those taxes now and pay taxes later at a predictably lower tax rate. Who knows what the tax laws will be in the future? However, if things stay relatively consistent with how they are now, if you, for instance, are at a lower pay scale later on during retirement, you will be paying much less in taxes overall. All right, so now that we've gone over the benefits of the 401k, let's go over some of the logistics of the account. For the years of 2020 and 2021, the maximum amount that you can contribute to the account is actually going to be $19,500. For some people, that can just be way outside their budget to actually contribute to because that money could actually be served for other financial needs. But there is another caveat to this, which I want to say is really important, and that is if your employer offers an employer-sponsored match to your 401k, absolutely take it, because that is just free money that you're going to be missing out on if you don't contribute. So what this means is that if your employer is offering a match for a certain percentage, say 3% of your income, you just want to make sure you're contributing 3% of your salary to your 401k. So let's go back to the example. If you're making $100,000 and your employer is saying, we will match 100% of 3% of your income, well, that means that if you contribute $3,000, which is 3% of your $100,000 salary, your employer will then match you another $3,000. So that's 100% benefit that you don't want to be missing out on by avoiding a 401k plan. Okay, so a very common misconception for these types of contributions from your employer is that they actually count towards your 401k contribution limit of $19,500. This is definitely not true, so don't believe it. The actual total limit from you as well as your employer will be $57,000 for 2020 and $58,000 for 2021. That is an unbelievable amount of money, and your employer, if they're generous enough, can match all the way up to that total limit. I don't know many employers that do. I know a couple of tech companies that will match 1-for-1. So if you contribute $19,500, they will contribute $19,500, which is absolutely bonkers in my mind. But yeah, it's possible. All right, so the other aspect of the 401k that I want to go over is that once you turn 59 and a half, like I mentioned before, you can then start to make withdrawals, and these are going to avoid any types of early penalties or any types of fees that come with it. However, but if you try to make unqualified withdrawals from your 401k before the age of 59 and a half, you're going to be hit with a 10% penalty on top of the income taxes that you're going to have to pay on the money regardless. And that 10% will wipe out a lot of gains that you've made throughout the years. So my recommendation is that if you can, try not to tap into your 401k for any types of emergencies. Rather, use your emergency funds and use your budgeting to help you, turn the tide and stay afloat. If you want any advice on emergency funds and so, I made a video up here talking about how to get started with personal finance. In that video, I talk a lot about the importance of an emergency fund and why they're so critical. All right, so a very common misconception about the 401k is that this is just a cash account, and that could not be further from the truth. The 401k is a very important investment vehicle, and you definitely want to put that money that you put in into different types of investments to fit your risk profile. So typically for a 401k, there are going to be employer-sponsored funds that you can pick from. These will typically include target date funds like the Vanguard series, which they can, depending on what year you want to retire, you can pick those ones. Like say for instance you want to retire in 2055 or 2060, those will have different types of ratios of stocks and to bonds to mitigate your risk profile for those types of retirement years. The other types of funds can be index funds. There might be some life cycle funds. There could be funds that track small cap and mid cap sectors as well. So you just want to keep a look at and see and do research there. Each fund profile is different, as well as each offering offered by each company. So I don't have a general answer to all of this. I would say if you can find an index fund that tracks the US stock market or the S&P 500, that would be a really good start. Some of the aspects that you want to look out for as well with respect to the fees for these accounts is that you want to look for funds that have fairly low expense ratios. That is, the expense ratio is the cost of just holding the fund. So for instance, for VTSAX, which I've mentioned before in the past, the expense ratio is 0.04%. So for every $10,000 you hold in VTSAX, Vanguard will take a cut of $4. There are other funds out there which will charge 1%, or even some egregious funds that will charge 2%. If you think about it, over time, these funds and these fees will add up, and that will cut into your overall gain in these types of funds. So be wary of that for sure. So that just about does it for me for this video. I just want to leave you with 3 ending thoughts to make sure that you keep in mind from this video. Definitely, if you forget anything from this video, keep these in mind. The first one is that the 401k is just a great way to reduce your taxable income as well as preserve some of your hard-earned money for retirement, and then you can help defer those taxes until much later on. The second one is that you definitely want to make sure that you're contributing enough to get the employer match. This is just free money that's going to be left on the table if you don't take it. So just please, at the bare minimum, get that employer match. That's just free money. And the last one is just management fees from these types of funds for 401ks. Try to reduce the amount of fees that you have to pay overall by as much as possible. Even if a fund looks very attractive and it has a really sexy name in it, don't fall for it, especially if it has a high expense ratio. Just stick to the tried and true basics of having a regular index fund that tracks the total stock market, looks at international stocks as well. You can even mix in some mid-cap and mid-cap sector stocks. Just make sure those funds have a low expense ratio. Alright, well thank you very much. If you made it all the way to the end of this video, really appreciate it. Definitely feel free to leave a like below and leave a comment and let me know what types of funds that you're invested in and what you learned from this video. If you're new here and you want to see more content, feel free to subscribe too. All right, until next time. Cheers.